Triple leverage ETFs allow you to triple the returns that you would get from trading regular ETFs, which sounds great because who doesn't want to triple their money? But the problem with triple leverage ETFs is you still need a lot of money to get started. Because if QQQ goes up by 3% one day, TQQQ is going to go up by 9%, and if you invested $1,000 into that, you'd only make a $90 return. But if you invested in options instead, you might be able to make a $300 to a $500 return. So in today's video, we're going to be comparing options trading to triple leverage ETFs. I'm going to go through the pros and the cons for each of these, and then I'm going to help you decide on which one is best for you. Triple leverage ETFs have been around for a very long time.
It's been 84 years.
TQQQ came out about 10 years ago or more, back in 2010. So these aren't a very new product, but they have been gaining a lot of popularity over the last couple of years because of the extreme volatility that we've been seeing in the market. This added volatility is making these ETFs move more than they otherwise should, because whenever the regular ETF that these are based on moves, a triple leverage ETF will move by 3 times that amount. So if QQQ goes up by 1% in a day, that means that TQQQ will go up by 3% in a day. And if QQQ goes up by 3% in a day, TQQQ will go up by 9% that day. So it triples the returns that you would otherwise see from the regular ETF. And you can also bet on the inverse ETF. So there's SQQQ, which is an inverse triple leverage ETF for QQQ. So whenever QQQ goes down by, say, 2%, that means that SQQQ actually goes up by 6%. So you have regular leverage ETFs, and then you have inverse leverage ETFs that allow you to bet on the downside. And these typically triple the performance of the underlying ETF itself. But
I like big butts.
This is only on a daily basis, because whenever it comes to percentages, if something goes up by, say, 3% a day, that is going to compound over that time frame. So let's say that QQQ goes up by 1% a day 5 days in a row. At the end of the week, it's going to be up by 5.1%. But TQQQ is going to go up by 3% a day 5 days in a row, which means at the end of the week, it's going to be up by 15.9%. And if we divide 15.9 by 5.1, we don't get 3. It's actually a number that's slightly greater than 3, so this compounding interest adds up.
Money add then multiply
To where you're not going to see that same 3 times leverage over time. And this also works in reverse. But actually, if QQQ falls, say, 5% every day, 5 days in a row, bloody hell, it would be down by 22.6%. TQQQ would be falling 15% a day. And at the end of the week, it's going to be down by 55.6%. And if we divide 55.6 by 22.6, then we get around 2.4. Not even close to 3 times leverage. So it's not going to have the same compounding effect whenever the stock starts to go negative, which could actually be a plus. But it would still be down by 50%, which is a lot bigger of a loss than the 25% loss that you would take on regular QQQ. And finally, the stock market is very choppy, like we've been seeing over the last couple of months. If QQQ goes up by, say, 5% one day, and then down 5% the next day, then it's going to be at 99.75% of its value. But if TQQQ triples that, goes up by 15% one day, down 15% the next day, then it's going to be at 97.75% of its value. So you would have lost 2% more in this choppy market, and that's really the downside of triple leverage ETFs, because you have this, and then these also gain their leverage from derivatives. So naturally, they have a lot of time decay associated with them, which brings me to the cons of triple leverage ETFs. The cons whenever it comes to triple leverage ETFs, again, is time decay that's associated with the derivatives that they trade. Now, this can also be said about options trading, because there's data associated with options, but with triple leverage ETFs, you wouldn't really expect this of them, because it's supposed to mimic 3 times whatever QQQ does. So there's kind of this hidden tax in triple leverage and other leverage ETFs.
Where's all your money gone, Daddy?
Taxes.
And this is why triple leverage ETFs are meant for day trading. So if you're a day trader, then this is great, but if you're looking for swing trades, then this might not be the best place to put your money. So that's one of the cons, I think, whenever it comes to triple leverage ETFs. It kind of narrows you down to being a day trader, but that can be a pro for somebody else. And another con whenever it comes to triple leverage ETFs is that you get pretty small returns. Usually QQQ only goes up by, say, 2% or 3% in a day, which means that you can only make about 9% returns, which isn't a lot whenever you compare this to some options trade. You can make 30 to 50% on an options trade where you can only make about 9% using triple leverage ETFs. So options trading gives you more leverage, but this can also work against you if you're wrong in the trade. But the higher returns of options trading makes it a bit more attractive for me. And the last con whenever it comes to triple leverage ETFs is you have to pick one direction or the other. Stocks can only go up or down in order for you to make money with the triple leverage ETF. Whereas with options trading, you could trade iron condors, iron butterflies, and make money on the markets trading flat. But the pros whenever it comes to trading triple leverage ETFs is that you have a lot less to lose, because QQQ can't fall to zero within a day, and if it does, then we have a lot more to worry about. But it would be very hard for you to lose all of your money in a single day trading a triple leverage ETF versus options trading. You can lose whatever you put into your trade. So that's one of the pros for trading triple leverage. You can't lose as much money. And another pro is that it's pretty simple.
Are you sure about that?
You only have to bet on the stock going up or down. You don't have to worry about expiration dates. You don't have to worry about Delta or the other Greeks. You just have to pick stock going up or stock going down. So it's a lot simpler than option trading, which is definitely a pro. And the last pro that I have for triple leverage ETFs is that they have better returns than non-leverage ETFs, because with regular QQQ, again, you can only make 2%, 3% in a day, versus TQQ, you can make 6 to 9%. But this still doesn't compare to options trading, which brings me to the pros of options. And the first pro is you get much larger returns. And this can also go into the cons if you're wrong about the trade. But with options trading, you can get like 30, 50% returns. So if you're starting out with just, say, $1,000, you can make $300 to $500. Versus with a triple leverage ETF, you might only make maybe $90 with that $1,000 investment. So options trading is a bit more small account friendly versus triple leverage ETFs, but it's also a lot more risky. But another thing that I like about options trading is that you can make money even if a stock market trades flat. Again, we can trade iron condors or iron butterflies and make profits even when the stock market doesn't do anything. So options give you a lot of different ways in order to make a profit, versus with triple leverage ETFs, stocks can only go up or stocks can only go down for you to make money. And another great thing about options trading is that you can do long-term holds, versus with triple leverage ETFs, again, they're more geared towards day traders. But if you're doing options trading, then you could buy something like a leaps option. You get a little bit more leverage out of it than you would with a triple leverage ETF, and it doesn't have the same effect of losing value over time because the triple leverage ETF triples whatever the regular ETF does. Instead, you have time decay working against you, so you are still going to lose a bit of money each day that passes for your option, but this allows you to trade on longer time frames than a triple leverage ETF. And the last pro that I have for you with options trading is that you can set your probabilities. So whenever it comes to options trading, you have delta, which is how much your options price changes for every $1 change in the stock price. But this is also an estimate of the percent chance of your option expiring in the money, which you can use to determine your max profit or max loss whenever you're trading spread options. So you get the chance to determine your probability of profit, whereas I feel with leverage ETFs, you don't really get to set that percent chance of profit. So that's the last pro for options trading, but there are a lot of drawbacks here. First, you can lose whatever you put into your trade for an option. So If you put up your life savings on an option, you can lose your life savings. So if you buy an option for, say, $30,000 and that option expires out of the money, that means you just lost that $30,000. But with triple leverage ETFs, you might only lose maybe $3,000 on that trade. So triple leverage ETFs will save your portfolio, whereas options trading can blow up your portfolio. And the second con whenever it comes to options trading is that time decay kicks in a little bit quicker, especially if you're using shorter dated options. If you're using, say, a 0 data expiration option, then by the end of the day, that option is going to be worth 0 if it's out of the money. But if you're trading weekly options, there's so much time decay with these options because of the high theta values, and this is going to lose you money quicker than if you were to invest in a triple leverage ETF. So that's another drawback for options trading. And the last one is that options trading is pretty complicated, honestly. It took me years to get to where I'm at with options trading, to where I'm somewhat consistently profitable. This year I made around $6,000 to $8,000 with a $10,000 portfolio, but it wasn't always like this. In the beginning, I had a 50-50 win rate, and I was losing money hand over fist until I started to learn about different strategies instead of just buying regular calls or buying regular puts, depending on how I was feeling. Now, I have a plethora of different strategies that I use, and I know more about the markets in general, which I feel like is important whenever you're trading options versus triple leverage ETFs. They're very simple. Again, that's one of the pros for triple leverage. But that's the pros and the cons for options trading and for triple leverage ETFs. Now let me help you choose which one you should use. Triple leverage ETFs are more beginner friendly because you're just assuming that the ETF that it's traded on is either going to go up if you're buying TQQQ or going down if you're buying SQQQ. And this isn't too hard, but with options trading, you have to choose what delta values to use, you have to choose what expiration date, you have to choose your strike prices, and there's just so much whenever it comes to options trading. So options trading is more of an advanced strategy, or triple leverage ETFs are more beginner friendly. But options trading allows you to trade in different ways. So if you're more of an advanced trader who's been in the game for a while, then options trading might be the better choice for you. And you can always learn more about options trading. I'm still learning to this day after trading them for 3 years. But options trading isn't for people that just want to bet on a stock going up or bet on a stock going down. There's a little bit more that you need to know in order to trade options. And another reason why you might choose one versus the other is depending on your account size. So options trading is, again, more beginner friendly and more geared towards smaller accounts. So if you only have, say, $1,000 to start out with, then options trading is going to be the better of the two picks. But if you have, say, $100,000 that you've saved up over the years, then triple leverage ETFs might be a little bit better, especially because you have less to lose whenever it comes to triple leverage ETFs. Again, if I put $100,000 into an options trade, I can lose that full $100,000. But with TQQQ or other leverage ETFs, it's very unlikely that that would go to 0 in the same day. And it also depends on what kind of trader you are. If you're more of a day trader, then triple leverage ETFs make more sense because, again, these are rebalanced on a daily basis, giving you 3 times the return of the underlying ETF. But with options trading, it gives you the option to extend your expiration dates out, such as leaps options with over a year until expiration. And you can also swap these out. You can day trade options or you can swing trade leverage ETFs. But in general, leverage ETFs are more geared towards day traders. And for me, I use options trading for swing trading. And finally, the last reason why you might choose triple leverage ETFs versus options trading is if you're looking for something simple, because not everybody has the time to learn everything that you need to know about options trading. It takes time in order to learn all about the different strategies that you can use, the different Greek values, learning what expiration dates to choose, and so on. So if you're more pressed for time and looking for something simple, then leverage ETFs are going to be the better of the two picks. But if you're up for a challenge and learning new things, then options trading is going to be the better of the two options. So that's all I have for you. Hopefully you choose the right one for you. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.